Today we are going to discuss about a very interesting strategy called poor man's covered stock or poor man's covered call. It's a cheaper alternative to the expensive or capital intensive covered stock strategy. Frankly, I did not know about this strategy for a very long time, and once I came to know about it, I was really hooked onto it and I used the strategy widely. So what is a poor man's covered stock and how do we build it? Recall the slide in the covered stock section where to create a covered stock in SPY, which is the S&P 500 index, you need a solid $24,000 just for one contract or one covered stock. How do we reduce this capital requirement and still get the benefit of a covered stock? Here is a poor man's covered stock I built in gold. So how do we do this poor man's covered stock? It's very simple. You buy a deep in the money call couple of months away long term and then sell a out of the money call near term. So here I bought a 19th January 2018 116 call for $9.49. So I paid $949, but buying 100 stocks would have cost me about $12,000. Instead of that, I'm paying $949 for a in the money call long term. And using that as a collateral, I'm selling a near term call for $1.04, so $104 for a net outlay of $8.45. So how do I make money? You take advantage of longer term option that decays slowly, which is the buy part on the top, and use that as a collateral to collect rent from short-term expiration. Close the entire position after 6 months or so when the decay of your long-term position accelerates. So the near-term option from March, I'm rolling it to April, collecting about another 35 cents. Then again I'm collecting it, rolling it from April to May and collecting $109. This cycle keeps on going on and on. You keep rolling it for 6 months and then close it down. Just to let you know, on the long-term buy option, it will be between 70 to 80 delta, and the short-term will be 25 to 40 delta. Okay, so I choose the short-term would be let me choose let's say 21st July is 50 days and go to the 21st July, and as I was mentioning, the short term would be about 20 to 30 delta. So let me just choose, let's say about 20 delta approximately, which is $125. So I just say buy a diagonal. It's called a diagonal. So I say diagonal, and it auto pre-populates the long term as August, but I'm going to change it to January. Let me see what happens in January, which is, we're talking about 70 to 80 delta. So a 70-80 delta is $110. So 19th January 18 is $110, which is about 80 delta, and July is $125, which is about 22 delta, and the total outlay for me is I'm going to pay $12.18 for this trade, which would be about $1,200. But think about it, if I had to outright own 100 stocks of gold, that would be about $12,000. In today's price, yeah, it's about $12,000 you might have to cough up. So I'm going to confirm and send. So what I'm trying to do is I'm trying to leverage and take advantage of the short-term time decay while keeping the long-term option as a virtual collateral. That concludes our poor man's covered stock strategy. Happy and safe trading.